Good evening, everyone. My name is Dmitry Fomichenko with Sense Financial Services, and I would like to welcome all of you to another webinar uh, with the topic of demystifying non-recourse loans with Solera Bank. Just a quick introduction about Sense Financial. We are a document provider company and a facilitator specializing in creating self-directed retirement accounts with checkbook control for our clients. So we help our clients unlock their IRAs and 401ks from their IRA or 401k prison and give them the ability to have virtually unlimited investment options when it comes to their IRAs and 401ks. And many of our clients invest in real estate. They in many different forms. Many do rental properties. I do myself own a rental in my retirement account using leverage. And that's the topic of today's presentation, non-recourse loan. Many not familiar with that, but per IRS rules, you're not allowed to provide a personal guarantee when you use leverage inside of an IRA or a 401k. And for that reason, the loan must be non-recourse. And there is only specific lenders and banks that offer those. And Solera National Bank is one of these lenders. So I invited them to come and join us tonight to explain to you guys this option that is available to you. Because using leverage will help you acquire more and ultimately increase your ROI. So tonight's presenter will be Avram Shebanyan, and he's with Solera National Bank. He has 10 years experience in commercial and business lending. And if we can go to the next slide, please. He specializes in lending with self-directed retirement account space and is a non-recourse loan expert. He's currently serving as a vice president of retirement lending at Solera National Bank. Avram has built the bank non-recourse loan portfolio growing to over $50 million. Avram resides in Denver, Colorado with his family, wife and 3 children, and he contributes time to helping youth through his church. And again, Avram is the expert, so please pay attention. Avram is going to be covering a wide range of information. We will have some Q&A time at the end. So if you can think of a question, please don't hesitate, type your question in a Q&A section, and we will make an effort to answer all of your questions before the end of this evening. And if for some reason we are unable to address your question this evening, then Avram can do so in the next day or so. Well, Avram, thank you for joining us, and take it away.
Thank you, Dmitry, for the introduction. I really appreciate that. Well, first and foremost, wanted to say, Dmitry, thank you so much for having me be part of this webinar, be part of this amazing group who wants to grow their real estate, wants to learn more about lending, and particularly lending in the non-recourse retirement industry with a non-recourse loan to grow their retirement portfolio. We'll be covering some topics here today. We'll be going over some scenarios. And one of the nice things about us is that we will give you kind of a perspective of what a bank actually looks at from perspective of underwriting. And, we'll be going over some deals, just kind of a disclaimer. Of course, everything you see here today is for educational purposes only. So just kind of wanted to get into it. So I'm going to go ahead and go to the next slide. And Dmitry, just let me know if you see it, just to make sure that we don't have any tech issues. Do you guys see the slide?
Yes.
Perfect. So as Dmitry already mentioned, that, Solera National Bank, we started our non-recourse lending roughly about 3 years ago, 3.5 years ago. And we have financed over $50 million in non-recourse lending across 50 states. the interesting and the nice part about the non-recourse loan is that, number one, there's not a lot of lenders that can do what we do, but at the same time, not a lot of lenders understand what we do. And just kind of wanted to give you some highlights, of our bank. We've done, like I said, over $50 million in non-recourse lending. We have helped, we have over 20,000 customers who do, IRA, LLC, solo 401ks. We have pretty much designed a product to help self-directed customers and help them grow their retirement portfolio, but also provide the necessary tools for them to be able to have that checkbook control and a bank to really understand what that is. And you can see that we could do wires, online wires. Our mobile deposits are over $1 million, and there's a lot more. Today we're going to focus on strictly non-recourse lending. And this first slide might look interesting, but thinking kind of through what separates us from thousands of banks. And you typically have your big banks, which we call them big box bank, which is and then we have the small banks, and that's kind of the bags that you see here. And the interesting thing is that when you think of a big bank, a lot of times, when you go to a bank, and maybe you've encountered this, but even if you went to a bank and said, I want to open up a checkbook control IRA LLC, they look at you with these, crazy eyes. What are you talking about? Now, imagine you went in there and you said, hey, I want a non-recourse loan to my IRA. They're probably, it doesn't fit them. And the reason why is because a lot of big box banks, if you don't fit in their box of lending, they just strictly won't do it. A good example is, Wells Fargo, Chase, Bank of America. Those are the big banks, and they kind of have their own criteria, and usually they don't want to get out of their comfort or even get into new industries because they kind of want to be in that particular commercial lending or CRE lending, or residential lending, things like that. But if it's something that's not really something they've heard of or they've seen, they usually just tell you no. And really the example of a small bank, I like to kind of put Solera in this as well. At Solera Bank, every situation, every request, it's different. And because you have different requests and you have different type of structures, you have different type of questions, different type of scenarios, because real estate is a very broad and very broad type of investment strategy, right? You can be investing into land, notes, securities, 1 to 4 families, retail space, and you really want to work with a bank that can kind of help you with the actual request. And that's kind of where Solera comes in the picture, because when we started this 3 years ago, we saw that there was a need in this product. And it's really a niche product, but it was really needed in the industry because a lot of people, they simply were having hard times finding a bank that understands what a self-directed IRA or solo 401k is, and understands that you have to have a non-recourse loan to be able to leverage your retirement money. So Solera, that's kind of Solera, Department of Non-Recourse was born about 3 years ago. And it was one of the best decisions we made. And the next slide, I'm going to be going over just giving you like kind of our bag, right? Kind of the stuff that we see maximum ability to help our clients. And I kind of broke it down into 2 categories, like some flexibility and no flexibility, right? So no flexibility, that'll be the stuff that you see where, we do right now really 3 types of terms. We do a 7/1 arm, we do a 10/1 arm, And then we also do a 25-year fixed rate product. Now, some of the things you might be asking yourself is, or maybe this is the first time you're hearing terms as 7-1 ARM or 10-1 ARM, but really what that means is it's an adjustable mortgage. So what it means is the 7 or the 10 means that's how many years it's going to be fixed, and then the 1 means after the 7 it will be what's called adjustable. Now, our adjustable mortgages, which are the 10-1 ARMs and the 7-1 ARM, they are amortized over 30 years, which really helps a lot of people with cash flow. The other part is we have kind of no flexibility there because those are just the terms. Some flexibility is, the origination fee, the rate, the DSCR, the minimum loan amount, the reserve requirements, max LTV is 70%. We might be able to do something higher, if it makes sense. As I mentioned, we'll go actually over some scenarios here, but I just kind of want to just briefly pause here for a second and just kind of give you guys some information. As we hear today, we are in a rate raising environment. Rates are changing, from the last, 7 to 8 months, they've been changing almost on a monthly basis. And, it's very hard to, keep up with the rate rising environment. There's questions about economy, and a lot of people, they're trying to strategize. How am I able to buy real estate with, such high rates? And I kind of wanted to share like a little, kind of maybe like a testimony even, but interesting part is that, when you buy a real estate, really the bank looks at two things, and that is your cash flow and the ability of your purchase power, right? How much money you have in your retirement. And we still see quite a bit of requests, every day for us to finance deals at a higher rates. Just to kind of give you guys an example, after the pandemic, rates were for non-recourse lending, they were in the 5.5, 5.75. Today, the rates are between 7.75, 8.75%. And really, all of that is driven by, your loan amount, your cash flow, your condition of the property, location of the property, all that kind of plays into a role. But really a good factor is, how strong are your rents? And what I'm going to do here, again, I'm going to go over some scenarios. And, towards the end, if you guys have any questions, you can put them on the chat. But I'm going to be kind of going over and showing you, what the actual bank looks at. And I'm going to actually show you our like a screenshot of our actual one of our underwriting worksheets that we use. I feel like in this industry, there's probably someone on this call, or even myself, has always heard this question: how does a bank underwrite the loan? Like, I'd like to understand how the bank does it, so then I don't have to worry about, kind of wasting my time and looking at the wrong deals or the wrong properties. And this is the opportunity to really see and dive deep on kind of what the bank looks at. So I want to kind of give you guys the first example here. It's a scenario number one. This is in Statesville, North Carolina. Very interesting. This house was a full-on remodeled turnkey property. As you can see, it was a 4-bedroom, 3-bathroom, 1,800 square feet. The purchase price of this property was $220. The expected rents were $3,500. The year it was built was 1916. Even though in our usually we like properties after 1950, but this property was 1916. Last remodel in 2022, and the funds in the IRA were $245. So kind of going to the next slide here. This kind of gives you a just brief understanding, like, right? So is this a 1 to 4 family? Yes, it is. 1 to 4 family means that anything from a condo to a fourplex or quadplex is what they call it in the industry. Was it built before 1950? If it was a no, it would be in red, or yes, right? In this case, we put it, even though it was built before 1950, we put yes because the property had a full remodel, pretty much like a gutter job remodel from studs out. So we just consider as pretty much a new property. It's in New York, New Jersey. Then it just kind of gives you some highlights. But really, the one I want to kind of dive deep here is this underwriting spreadsheet. Now, this is kind of what the bank uses internally. But the reason why I wanted to present this today is to kind of really show you, how does the bank think? How does the analyst who looks at your deal really justifies, okay, what is the max LTV that I can do for a borrower, and how we make that happen? So really what we do is, where you see all the stuff in yellow, this is kind of what the analyst will plug in. So we work with customers, purchase price at this example was 220. And we did an example here. We asked the customer how much you wanted to put down. They said 40%. So they said 40%. So they put more than minimum requirement is 30. So they put 40% down. It calculates the origination fee, which is 1.5%. We do estimation of closing costs, title, insurance, recording, just to kind of understand how much roughly it would cost for closing costs and inbounds. And essentially, this came out to roughly around $4,700. Plus, you have your down payment, which is $88,000. This customer had $245,000, and they made it very clear to us on our initial call. They said that I want to put $100,000 into this property. So build a scenario for me where I have enough money for the reserves, I have enough for down payment, as well as closing costs. So as you see here, we use what's called debt to service coverage ratio, or they're also known as DSCR loans. So what we do is we really look at your main factors of your expenses and your revenue. So we put 7.75 because she put 40% down. This investor put 40% down. So we gave them 7.75, which is our lowest rate right now. And her rents were at, this example was $1,750. And you can see here that we look at taxes, insurance, see if there's any HOA. We do look at vacancy in certain areas, if it's like a quadplex or a triplex or a quadplex. And then there's also, we see that, property expenses and things like that. And what that does is it tells us what her revenue will be, which is what's called net operating income. And then what's her mortgage expense would be, which would be, in this case, was $11,384. And then when you divide these two numbers, as you can see right here, I kind of looked at it for you guys to see. Annual rents minus taxes, annual tax, annual insurance, annual HOA, annual property management fee divided by P&I, that gives you what's called a debt to service coverage ratio. So in this particular example, our minimum is 125, but this customer had 144. So the way to think about this is, for every dollar that the customer spent in expenses for the property, they will bring in $1.44 in revenue. So this is a very good cash flow positive property. So the next example I'm going to give here, oops, do you guys see that? Scenario number 2. So Solera National Bank really specializes in long-term and short-term rentals. So the long-term rentals is, we look at turnkey. We also do refinances when customers, did fix and holds, and we come in as a refinancing bank to pay off, or refinance another existing mortgage, like construction loan or a hard money loan or a private note. And then we also do short-term rentals, which is another one we really do a lot. So this scenario just kind of shows you what the bank looks like from perspective of a short-term rental. So if there's any short-term rental investors here, do you guys see my screen?
Yes, you can see it.
Okay, perfect. Wonderful. Thank you, Dimitri. So this property is in Pigeon Forge, Tennessee. And if you look at this property, it's a 1-bedroom, 1-bathroom, 720 square feet. The purchase price was $415. Estimated rent was estimated rent based on AirDNA and Rabu. So AirDNA is a good source. For those who are on the call that are short-term rentals, know that there's Airbnb, but there's also what's called AirDNA. And what AirDNA does, it actually gives you factual numbers, like factual rental revenue that's brought in the vicinity of the address you plug in the system. So let's just say, for example, I live in Denver, Colorado. I can put a certain address and say I have a 3-bedroom, 3-bathroom home here, a townhome, and it'll show me through AirDNA how much other properties are, renting for, and they'll also show me what other properties are bringing as revenue for a similar home like mine. So what Solera Bank does, we ask the customer, most customers provide that to us, and it shows us some of the data. This customer had, as you can see, it's a cabin, and this customer had about $225,000 in their IRA. I'm just going to go to the next screen because it kind of summarizes everything here as well. So if you see here, because it is a short-term rental, the usual on our short-term rentals, we usually go up to 60% LTV. We can go sometimes to 70% LTV on short-term rentals, but it is a little bit tougher, and I'll explain why in here just a second. So here's the same thing. We're plugging in the numbers. We look at, you have purchase price, customers willing to put 45% down. We have the origination fee, kind of similar stuff here. But really, I want to kind of go over here on the right side. On the right side here, as you can see, the rate's a little bit higher. So because the banks is going to be assuming more risk because it's a short-term rental, there's definitely going to be like we like to call it like a premium on the rate, because it's a little bit, when you have a long-term rental, you have a lease in place. With short-term rentals, you don't have that. You're just all basing it off of what the properties can rent, within a certain percentage of time on a monthly basis, whether it's 10 days out of the month or 15 days out of the month, and so on and so forth. Now, as you can see, this property is very tiny, 1-bedroom, 1-bath. It was like right under 700 square feet. It's a cabin style, but it was zoned as 1 to 4 family. Now, what we did here is we do what's called a stress test. So what we do is we take the customer's data that the investor provides us, and then we also have what's called an appraisal rental survey. So when we send an appraiser out to look at the property, if it's an Airbnb type of property, we ask them to provide us a short-term rental market analysis. So what would happen is this appraisal came back and said the property can actually rent for around $4,500. We used $4,000 for our example for underwriting, and the property cash flow pretty well. It cash flow 1.72 to 1.25. But what we do is we do what's called a stress test. So what we do is we say, okay, if the monthly rents customers estimating $4,000, then it would cash flow at 1.72. But then what we do is we'd say, okay, what if we discounted the rents by, let's just say 10%, would it cash flow? And then we'd run the scenario. So what we'd do is we would lower this number right here, which will then by nature lower your DSCR number. And then we'll discount it by 25%. And then we'll do what's called a break-even point to see what does a customer have to have on a monthly basis to break even, to pay the mortgage, to pay the taxes, the insurance, the HOA, and so on, all their fixed expenses. And in this example, it was around roughly around $3,000. So we felt comfortable as a bank to do this deal because of really 4 reasons. Number one, because customer put 45% down. That's a pretty big that's a pretty big down payment, which gives the bank some peace of mind. Number two, the rate was a little bit higher on this one. So in case of default, the bank obviously has been collecting 8.5%. And then the third thing was the big one, that was the cash flow. We were able to see that if the property can rent for at least $3,000 a month, then it will break even. So we were confident enough to be able to say, okay, we think this property can for sure get at least $3,000 of rents. Now, and the fourth thing is that the customer actually had, after closing, around, roughly around, you can see here, around like 60 some $1,000 left in their IRA, including the reserves. So we knew that if the customer had a little bit of a harder time to getting kind of the Airbnb, VRBO started, then we know that they had some cushion in the IRA to be able to pay their mortgage while they're getting the property, up and running. So we ended up doing this deal. It closed actually, roughly about a couple of months ago, and it's kind of on our books. So one of the things I kind of want to talk about here in just a second is that oftentimes customers ask me, when I'm doing their initial preliminary underwriting, they'll say, "Hey, Abram, are you willing to ever do a loan below 1.25 debt service coverage ratio? Are you willing to charge less than 1.5%? Are you willing to give us a discount on the rate?" And the answer is very, it's not as easy to just say, yes, we can, but it is also, we can, but it has to make sense. So every deal, truly, as a bank and as, being the head of the department, we look at every deal differently. Every deal stands on its own. And this last scenario, I kind of I put it on here. Obviously, it was done about 2 years ago, I think, if I'm mistaken. The cool thing about it, if anybody knows a little bit about Mercer Island, Washington, this is like between, if I'm not mistaken, between Bellevue and Seattle. And it's actually where Bill Gates owns about 10 rental real estate. And this is actually next door to Bill Gates. This is just a little bit of a fun fact. But this property, you will see that the bank really, when we say we have flexibility, we really do. When we say we look at the deal on its own, we really do. And here's why. This property was roughly about $1.12 million. The expected rents were around $4,100. It was built in 1947. It was remodeled in 1985. We did this loan around 2020, if not mistaken. And the funds in IRA were $720,000. And as you see this picture right here, we have a couple of reds right here, right? So the DSCR was 125, it's 12. And then we have, right here, was built before 1950. It was remodeled, like the other property was remodeled in 2022. It was fairly all refurnished. It was remodeled, had new, plumbing, new electrical. But in this property, the last time it was remodeled was 1985. So it was about, 30 years, old on the inside. So when we looked at this deal, you even kind of see a different spreadsheet here. But when we did this deal, again, like I said, the rate was so low because we did a couple of years ago. But we actually, if you look at it, look how low the leverage is. The customer put 53% down. They really wanted this property, again, for a variety of reasons. But the biggest was appreciation in that area. And after the pandemic, that market fell a little bit hard. And they had this opportunity to buy this home, and they're willing to put a majority of their funds that was in the customer's IRA to this property. So they actually came to 4 different banks before they saw us online. And they came to us, and they really thought they won't be able to do it. And then we said, yeah, we'll be able to do it for you. And here's the interesting part. The customer put 57% down. And if you look right here, the DSCR was 120. So this would be what's called a policy exception. So every bank across the United States has usually what's called a chief credit officer, who's kind of in charge of all the policies, of all the procedures of the underwriting that the analysts have to use. So in ours, we have a requirement that you have to cash flow 1.25. So and if it doesn't meet that, then it's what's called a policy exception. Now, this customer, because when we presented it to our loan committee, this customer DSCR was 1.20. The reason why we ended up doing this deal was because the customer was willing to put more money down. We originally only asked for 50%, but then she said I would put 57% down. But at the same time, I'm willing to give you an additional 6 months reserve. So if you see right here, it says 12 months. Usually our reserve requirement is 6 months worth of your monthly mortgage, which is principal, interest, taxes, and insurance plus HOA. The customer said, I'm willing to give you 12 months as a reserve to give you guys peace of mind if you guys can finance this deal. So the mitigating factors here were we had a low loan to value, a high down payment. We had at least 1.20 DSCR, and we had 12 months reserves that can cover 12 months of our payments, which is 1 year of our payments if something happened, if something was to happen. I kind of wanted to talk a little bit about common reasons for loan declines. But before I get into that, I kind of want to just briefly talk about a little bit about the credit. Whenever when you call any bank, when you call for any type of lending, usually they always will ask you for personal guarantees. They'll ask to check your credit. You know, they're going to ask for your financials, your W-2s, your pay stubs, right? There's actually non-recourse lenders that I'm aware of in the industry that actually still tell customers that they need to provide their W-2s and their tax returns and things like that. At Solera National Bank, we actually streamlined that because it has to be a non-recourse loan, because you cannot personally benefit from financing, which means you can't guarantee the note. Then what that means is that there's no need for us to check your tax returns, your W-2s, your pay stubs, and so on and so forth, because it becomes irrelevant. So most of the properties that we look at, it's strictly cash flow. So it's really important for all of you who are real estate investors, which is why you probably joined this webinar, to really learn about non-recourse lending and leveraging your IRA to buy real estate. The first question you should ask yourself when you look at deals, is it going to cash flow? Is it going to bring me profits? And if you can say that first question and answer that is yes, then get into the details of those things. Run the spreadsheet, create your analysis, just to make sure. You can actually even go to Google and type a DSCR calculator, and you just punch in your numbers, your rental rate, your income, your taxes, your insurance, your HOA, and they'll give you the DSCR calculation. So at Solera Bank, obviously we are a bank still, and we do have certain things that we don't approve. And I kind of put just common reasons why we decline customers. One of them is a credit report has bankruptcy, delinquencies, or foreclosures in the last 7 years. Really, it's 7 years, but the reason why we put that there, even though it's a non-recourse loan, we still check your credit because your credit talks about your credibility. Now, there's different scenarios. So it's not just a flat no. There's different scenarios. There's different things that happen in life. So we will obviously talk about those things with our customers, and then we will present that to our committee, and our committee will then vote on it. Do you want to do the loan or not? But usually when we see bankruptcy, is definitely like a hard stop until we get some more information. But usually most cases, those deals don't go through. The other one is when we say the property does not cash flow 1.25, again, it's case by case. But most deals, if you can't put more money down, if you can't put more money in your reserves, the banks has a hard time. If they don't have mitigating factors, the bank has a hard time doing the loan because it has to cash flow. Because the only thing that the bank can do is rely on your rental income. So if your property is not producing income, then that can jeopardize the loan and potentially lead to defaults. So we definitely look at the debt to service coverage ratio. But you saw a deal that I went through, we did at 1.20, but there was mitigating factors. The other one is we get this quite a bit. Hey, Abram, do you guys do fix and flips, fix and holds? The answer is no. We do. We don't do any property that's not in habitable or a condition to live in or needs major repairs, which is we consider what's called like a fix and flip or a fix and hold loan. Most of the stuff that we do at Solera Bank is long-term rentals. Short-term rentals are turnkey, habitable and good condition, and that's kind of what we specialize and most competitive in the marketplace. Now, we have done quite a bit of refinances. So we're, there's hard money lenders, private lenders, bridge lenders that do like construction or remodel loans. And then Solera Bank kind of comes into the back end when everything's done and refinances the loan and the note. One thing that I did want to touch base is, when I say major repairs, that means like, you got holes in your walls, you don't have a bathroom stall, your sinks, faucets are gone, your bathrooms are destroyed, right? That's major repairs. Now there is what's called cosmetic repairs, like paint, carpet, touch up, right? That's a little bit different. We can definitely do a property where if it just needs like a face uplift, we can definitely still do it, as long as like very minimal. The other one of the reasons why we decline which is the most one that we see, is insufficient funds for closing, down payment, and reserves. Because it is a non-recourse loan, Solera National Bank, we do what's called we have to have enough money in your retirement account. There is no way to do a deal if you don't have the money in your retirement account, because you can't use your personal money, with Solera to be able to fund the loan. And you shouldn't be doing your personal money anyways, but we strictly use retirement money. So if you don't have enough money in your retirement account, then we unfortunately can't do the deal. Other requirements or exclusions, obviously we always want to have first deed of trust on the loan. We don't do any junior liens. We require title insurance. We do auto pay requirements. It must be tenant ready, which means turnkey property ready to live in. We do 5+. We're not going to talk about that today, but we do on a case by case. We do 5+ loans, which is commercial lending. Has to have all the utilities, of course, water, sewer, electrical, and so on and so forth. And we do not do any type of property such as nursing homes, urgent cares, or retail facility, or they're not eligible for financing. So it's mostly like I said, 1 to 4 families and 5+. This is it for me. I mean, I guess if you have some question answers, Dimitri.
Thank you, Avram. Great information.
Thank you.
Yes, we certainly do have some questions, and let me go to the Q&A. And if you guys have any questions, there is still opportunity to ask them, so go ahead and type them in the Q&A section. A question from Steve: does your bank provide non-recourse loans secured by well-documented hard money loans? And he's explaining, I do have an LLC owned by my Roth IRA and also solo 401k. I'm looking for a mortgage note secured line of credit at 20% of the mortgage note balance. It will be used for a cash management purposes. I think I know the answer, but Avram, I'm gonna let you
the answer will be no. Yeah, the answer will be no, because number one, it'll be junior note, because it would be behind it, would be second. And number two is we don't do any type of leveraging of other note debt. So the answer would be no for that.
And I think in addition to that, because he's looking for a line of credit, you guys don't do any line of credit, and I'm not aware of any non-recourse lender who offers line of credit.
Yeah, there's actually no, not that I'm aware of, I should say, Dimitri. Nobody does lines of credit because usually they require guarantors, and you can't have guarantors in the self-directed IRA or 401k.
Another question from Pierce. He's asking, is the ARM, because you presented several options there, 5 on ARM, 7 on 1 ARM, 10 1 ARM, is it interest only or is it amortized?
It's a fully amortized loan, so principal interest starting the first month.
Right.
That is correct. And just to kind of add to that one, we don't escrow either for taxes and insurance because of commercial loans. So the customer or the borrower will be responsible for paying their taxes and their insurance. So.
Okay. Joseph asking, I think he's referring to the first example that you used in the first scenario. Could she have bought the property with only IRA funds, or does she have to use leverage in order to use the IRA funds? I think I can answer that. One, no, you certainly don't have to use leverage to buy. You can just buy with all cash using your IRA. Many clients do that, but using leverage allows you to use other people's money, and ultimately that increases your ROI, because instead of, let's say, buying one property, you can buy two, and you can potentially double the benefits. But Avram, do you want to add anything to this?
Well, I think you handled it. I mean, there's nothing else to add to that one.
Okay. Then Eric asking, in one of these scenarios, can you show what will be different about a recourse loan? How do we prove that our 401k or an IRA has a non-recourse loan? How does it change the bank's risk?
I'd have to probably ask a follow-up question to that. If it's a recourse loan, it would have to mean that it is guaranteed. So non-recourse means you're not guaranteeing the note. Recourse means you're guaranteeing the loan. And then there's what's called partial non-recourse, which could be like 50% of the leverage amount can be recourse, and then the other 50 non-recourse. So I guess the first question would be is if it's non-recourse, if it's recourse, then we can't really do anything. So I guess maybe if we can elaborate a little bit more on that.
Yeah, probably it's a good question for like a phone call. But the bottom line, let's see who Eric was asking this question. The bottom line, Eric, is that recourse is not an option for an IRA or 401k. If you do have an IRA or 401k and you wish to buy rental property in it, non-recourse is the only option for you. You're prohibited from providing personal guarantee. So again, recourse is not going to be an option. And the difference between recourse and non-recourse is that recourse loan, normally when you buy a primary residence or rental that you personally buying, you go to the bank, the lender will look at you and your ability to pay, and you will be on the hook for that loan. They're still going to look at the property, but you personally responsible for that loan. And non-recourse is different. It's strictly asset-based lending, where the property is the only security for the loan. Avram, anything you can add to that?
Yeah, the only thing I would add, Dimitri, that's well said, right? If it's a non-recourse loan, our conversation, of course, we called, we'd tell you right away what Dimitri said. It's prohibited transaction. You can't do that. Now, from perspective, from Eric's question here, it says, does that change how the bank looks at risk? The bank won't even look at the deal because we know at Solera that if you have a 401k or an IRA, it has to be non-recourse. And I'll give you guys even like just a little bit of a scenario. We've had a customer where they by accident bought the property under their name, and then they thought they can move that property into their 401k, and we said no because it's already been owned by their name. So, which means that it was recourse, and then they try to make it non-recourse by refinancing and putting it in now, which is considered a prohibited transaction. We just kind of said we can't do that. So I think the best way to understand is like if it's non-recourse, we can definitely look at the deal and definitely look at your retirement account. Make sure you have enough proceeds to buy the property you're looking for. If it's non-recourse, if it's a recourse, then the answer will be probably you'd have to put that under your own name outside of retirement.
Another thing to add about the bank's risk is that, yes, bank is taking a larger risk by doing a non-recourse loan because you are not in the picture personally. You're not responsible. Bank cannot come after you if you fall behind on the payments. The only thing they can do is they can foreclose on the property and take that property to satisfy the mortgage. So they do take the larger risk, and that's why normally the down payment is larger for non-recourse loans. But again, when it comes to an IRA or 401k, you don't have options. It's like trying to compare apples and oranges. We are not, or apples and potatoes. We are looking at non-recourse only because recourse is not an option with IRAs.
Yep.
All right.
Yep.
Moving on to Joshua, who's asking about with a short-term rental, aren't you going to get hit with UBIT since the profit is from business operation and not a passive long-term lease? Well, Joshua, this is not really, I think, question for Avram. It's has nothing to do with lending, but it's a good question to ask your CPA. And I'm not a CPA. I can maybe give you just some very general answer to this is that it depends on how short-term rental is structured, because I believe that some short-term rentals can be structured as a rental income and some as a business income where you will in fact will be subject to UBIT. But that's a question to discuss with your CPA. Moving on to Joseph, who's asking, I just opened my solo 401k with Solera, and it looks like it will take me 2 to 3 years until I amass enough capital to invest in a property with a non-recourse loan. Are there rental funds or partnerships that Solera engages in or could recommend, such as Delaware State Trust, but with a much lower investment threshold?
Yeah, the answer for that, unfortunately we don't, just because we don't give any financial advice or even recommendations, as we don't want to walk that line. So we always refer you to your financial advisor, who can maybe tell you some investment strategies that fit directly to your needs.
Yeah, same here, Joseph. We at Sense Financial do not offer investment advice, but I always tell my clients that, well, Solera, first of all, they're not in the business of investments. They're the bank, so they do offer checking accounts for your solo 401k and checkbook IRA. They do handle custodial services for an IRA, and they do offer non-recourse loans. That's it. As far as investments, that's something, that's why it's a self-directed IRA or 401k that you have. But I'm an investor myself, and I talk with investors on a daily basis. You are welcome to reach out to me directly. I can talk to you. I can learn a little bit more about what your situation is, and maybe can give you some ideas, some pointers that might work for you. You're not alone, and there are options, but you just need to brainstorm and see what's available. Okay, moving on to Francisco. Does real estate experience help with credibility and loan amount and rates if someone has managed and owned short-term rentals for multiple years? Avram?
No, it doesn't. Your experience and things that's part of underwriting, but really it's loan amount, cash flow, condition, and location is what determines the LTV and the rate.
Thanks. Again, it's an asset-based lending. It's not like a business lending. They don't look at you, how well you performed. They're looking at the property. Property determines whether you can get the loan. Avram, am I understanding this correctly?
Yeah, we don't. I mean, I always like to give this example. If you have a 401k with $200,000, but you made $1 million in your W-2 income, unfortunately, I only use the $200,000 in your retirement account. I don't look at you personally at all. The reason why we check the credit, I mean, people always ask them, why do you check the credit? The reason why we check the credit is that gives us a story, a credibility, experience story. Talks about your, how often you pay your bills on time, when you pay your bills on time, do you pay your bills on time, do you default on notes? Which kind of talks about character, which is why it's not a hard no when we run into those issues. We talk about it with our client, but most we look at, again, it's asset-based lending. It's all based on the cash flow. It's all based on the property, and that's really about it.
Thank you, Avram. We have another question from Jacqueline, who's asking, what about co-ops? Can you lend in a co-op? I'm not sure exactly what that is.
I'm assuming a co-op is like in Maryland, New York, Chicago, Illinois area, they have what's called row houses. I don't know if that's a co-op. We do row houses. We do condos. But I'm not sure if I'm answering the question, because co-op is kind of, in some areas co-op is a condo, in some areas co-op is not a condo, so, but to really explain it, we do row houses and we do condos. So that hopefully we answered the question.
Okay, so the answer is yes, but more specifically, you need to look at the property, I guess, Avram, to say definite, to give definite yes, right?
Yeah, definitely.
All right, so next question is from MJ, who's asking, where are reserves required to be held?
So usually if it's so there's kind of really two pieces to this question. If it's a custodian self-directed IRA, where, for example, there's companies like Equity Trust and, Full House Custodian, it has to be with them. If it's checkbook control, it has to be with Solera.
All right, thank you. Next, Junior says she joined late. Did you say that the calculator is available upon request, or that the calculator that was shown is how the bank assesses the deal?
Yeah, that's just personally we decided to put that on our today's webinar, because we wanted customers to see the back end side of things. So it is not for obviously it's for internal use, which is why I recommended that if you go on Google and just put DSCR calculator or debt to service coverage ratio calculator, it will do the same thing for you. But the spreadsheet is internal use, unfortunately. Yeah.
All right. Jacqueline has another question. If I use the solo 401k to fund an LLC to purchase real estate, is that possible? Avram, you're thinking.
Yeah,
So
I'm thinking. I'm thinking about about the question here for a second.
Well, let me jump in and try to answer that. So with solo 401k, you already have a checkbook control because you have the trust established, and trust is the buyer or the investor in this case. And sometimes, occasionally, rarely, that's more of an exception, a client wants to set up an LLC inside of a solo 401k to purchase a property. So then it will be like an equivalent to an IRA LLC, or your solo 401k will own the LLC, which will own the property. And I'm pretty sure the answer is yes. You can get a loan for that because it's going to be pretty much the same criteria.
Yeah,
Avram,
so I kind of understood what. Yeah, so I tried to think about that for a second, because there's a little nuance. If the solo 401k owns the LLC to buy real estate, that's fine. We do have to have the operating agreement does have to have the member be the solo 401k. And the reason why I say this, because I oftenly see where somebody thinks that the solo 401k owns the LLC, but it's really under their personal name, which is no good. So to answer the question, yes, we can definitely do, and we've done plenty of deals where 401ks own LLCs, and those LLCs go buy property. So yeah, we could definitely do that.
And to add to that is, remember, this is not just an LLC that you can go and you can file with the state and set up. It's an, as Avram mentioned, it's a special purpose single member LLC. So this LLC is created with a single purpose to be owned by the 401k. So the way it is filed with the state needs to be IRS compliant. The operating agreement for the LLC needs to be IRS compliant. So it's not something that you can just go and do. Like I said, we've done this a few times. Normally it's not needed, but again, if client wants it, it is possible. All right. Next, Brian asking, how long does the underwriting take?
I would say usually about 5 to 7 days for underwriting. Usually, I would say most of our deals we close within 30 to 35 days if it's long-term rentals, and short-term rentals that's Chevrolet control properties, I guess you can say. If it's custodian, like a self-directed IRA, about 40 to 45 days, because there's a little bit other additional steps that require for a custodian to sign off on the loan. So I'd say between 30 to 45 days to close the loan, but underwriting about a week, fairly quickly.
Next question from Sam. He's asking, do you lend non-recourse loans to Roth 401ks as well? Let me just comment on this question for Sam to understand that Roth 401k is not a separate, a vehicle. It's a solo. If you have a solo 401k and there is a Roth component, it's still a solo 401k. Just you have a different sub account. So I'm sure the answer is yes, Avram.
Yeah, that's totally fine. I mean, 401k or traditional Roth, I mean, that's just the type of money invested in a property. But
Exactly.
yeah, we just lend to the retirement account
It's
itself.
still a solo 401k, whether it's pre-tax
Absolutely.
money or Roth money.
That's correct.
Next question also from Sam. Do you lend non-recourse loans to self-directed Roth 401k? Well, I think
Same
we
answer.
just answered that. Then Jane is asking, when do you reach time? I have to take distribution from self-directed IRA. Do I need to sell the rental in an IRA? Well, it's not really related to lending here, but you don't have to sell the property that you have in an IRA as long as you have the cash to satisfy the RMD. And ideally, that's what I tell my clients. This is my goal and should be everyone's goal, is that you accumulate enough investments, passive investments in your IRA or the 401k that produce enough passive income, enough cash flow or interest income that will provide for your living expenses. So you don't ever have to touch your investments and you can actually pass them on to your children or other whoever you wish. But again, if there is enough cash, you don't have to sell. But if there is RMD and then you don't have enough cash, then you will be forced to either sell the property, maybe sell the portion of the property, or potentially take distribution in kind, because you can distribute property in kind to yourself to satisfy the RMD. So not really related to Avram. Let me jump on to the next one. A lot of questions today. Next question from Brian. Is there any prepayment penalty?
Yes, there is. So our prepayment penalty is if you sell the property in the first 18 months, you'll be subject to a 3% prepayment penalty of the original loan amount. So for the first 18 months, after the 18 months, there's no prepayment penalty.
Okay, thanks. So next question from MJ again. How do you work with borrowers to assist them in addressing UBIT and SDIRA tax requirements?
I mean, we actually don't. That'd be some your tax advisor or your accountant has to do for you, unless you have something else to add, Dimitri.
Just want to confirm that again, Solera Bank is not they don't handle taxes, they don't handle investments, they provide lending only. So if you use IRA to buy property, there will be some UBIT implications. You got to discuss that with your CPA. Next question from Terry. What about a non-recourse property brought with LLC in a partnership?
Yes, that's a great question. So when you say partnership, I'm going to assume for this example of an answer that it's another IRA. So at Solera Bank, again, this is more of a bank policy. We usually do loans where if it's one or two IRAs, and usually it's spouses, or immediate family. Like let's say, for example, say mom and a son have separate 401ks, and they want to invest into a real estate property, or a husband and a wife, they want to invest into a real estate property, and they have separate IRAs, separate 401ks. We can definitely do that structure. Usually we would use a LLC, special purpose LLC, where the member of that LLC will be the two IRAs or the two solo 401ks, or one or the other, and then we would lend on that. Now, we do not get creative when it comes to, like, I have 10 IRAs or 5 401ks. I want to go buy a property. We usually don't do that, just because it becomes a little bit messy in case of default. So, I would say if you have a certain scenario, the individual that asked that question, Terry, if you want to call me directly and present your scenario, I can tell you if our bank can handle that or not. So it's a case by case.
Let me piggyback on that, Avram, and ask you this question. So you said two IRAs are fine, and if it's related, what about just two unrelated people, two friends, they have two IRAs, and they wanted to buy property jointly? Can they do
that? Usually we don't. But again, a case by case, right? It's also about the deal, right? Is it high risk, low risk investment? What type of investment it is. I mean, we can definitely look at the deal. Usually, even if it's two friends, we could probably do it, but it has to be in a special purpose LLC, because we can't just lend to two. There's some, I guess, bank nuances. If you rent to two IRAs, like, how do you split the rental income? How do you split the mortgage payment? So we usually just have an LLC, special purpose LLC, where the two friends would invest in as members with their IRAs, and the property under that. So we definitely done that, Dimitri, just to kind of answer your question.
Okay, so possible, but gotta review the details to give a different answer.
Yeah, exactly.
And also, on the related note, Avram, if let's say if there is a client who has an IRA, and they also have some cash, and they want to pull IRA and the cash to buy that property, can you do a loan for them?
For clarification, the cash, is that personal cash?
Yes.
Yes. So that'd be considered a partially non-recourse loan, and Solera Bank does not do partial non-recourse loans.
Okay. Next, from Eric. So in these non-recourse loans, the Solera does in real estate, the bank's risk is that it stops paying cash. How has this worked out so far in the micro environment?
So in these non-recourse loans, the Solera does.
Not sure if I understand the question.
I'm assuming you're talking about what's going on in the macroeconomics, which is what's going on. We understand there's real estate. Real estate is kind of trickling down, the rates going up. I mean, if I understood your question correctly, really, there's no really specific answer. But the bottom line comes down to, if the note stops being paid, so if the mortgage payment is not being paid, the customer will go into what's called a default. And if it's a default and it's not paid in that period, then it'll go to foreclosure, and we'll take the property and sell it at a foreclosure auction. And at the end of the day, the bank's main priority, if the property goes on default and foreclosed, is to get the original loan, the original current balance paid off. So, I mean, actually, we can proudly say out of our 50 million loan portfolio that we have, over 50 million loan portfolio, we have had 0 defaults.
Okay. Yeah, if you put 40% down, I mean, I don't know how would you allow the foreclosure to happen on that. There's quite
You
a bit
wouldn't
of,
want to, I mean, you pretty much put them all your money at risk at that point. So
yeah,
most of the times, customers do everything they can to make sure the payments get paid.
yeah.
Right.
Next question from Jacqueline, who's asking, do you have to purchase one property at a time to meet the minimum loan amount, or can you buy more than one property at the time? And I guess to add to that is, can you kind of do like a portfolio loan?
Great question. Great 2 questions. So first question to answer, it's per property. So minimum loan amount has to be per property, 100,000. So and yes, we could do portfolio. Now, portfolios are going to be a little bit more trickier because the portfolio has to be bought from one seller, not multiple sellers. And or we can do a refinance if you own properties. But we definitely can do portfolio loans. And in that portfolio, also each property has to meet the minimum loan amount of 100,000. Now, if your property meets the loan requirements at 90,000, I'm pretty sure we can look at doing that deal as well, because cumulatively it'll be more, a larger loan amount.
Okay. Next question from Sangita, who's asking, can you combine personal funds with an IRA for down payment? And we already had a question like this, and Avram said that it will be a partial non-recourse, and the answer is no. Correct?
That's correct. That's correct, Dimitri.
Next question. One partner using SDIRA, the other partner using personal funds, and same thing.
Same question.
The answer is no. Next from Joseph, can you buy a property solely for the purpose of using it as a short-term rental? If I understand correctly, Solera Bank will use the RDNA, projected monthly rental income.
Yeah, great question. So yes, we do short-term rentals, as I mentioned, and we do have a certain underwriting, like I did in our scenario too. Now, we don't strictly use AirDNA. As you might recall, I also said we use what's called an appraisal rental survey, which gives us short-term rental market analysis in that area, and that's provided by an appraiser, which is a third-party company who's separate from buyer, bank, or seller, and he kind of looks at the market in the area. So we kind of look at both. We do use AirDNA, and we also use on Rabu, VRBO, and things like that. So we kind of look at a couple of items just to kind of really understand the cash flow of the rental income. And I probably assume why that person asked this question is that sometimes appraisers don't really know the market very well and don't provide the correct type of rental market analysis. So yeah, we definitely can look at AirDNA if the appraiser was too low, and the customer says it has some justifiable information such as previous rental history or partial rental history throughout the year. There's definitely things we can look at, and also AirDNA is one of them.
Right. Next question from CB, who's asking, can you refinance a property being held in your retirement account?
Yes, we can. That's correct.
And you can refinance existing loan, and you can also do a cash out refinance on a property that is on free and clear. Is that correct?
That's correct. Yes, sir.
All right. Next from Joseph, if you're currently repaying a participant loan on your solo 401k, can you still get a non-recourse loan? I think those are unrelated questions. The fact
I'm
that
not
you
sure.
have, yeah, the participant loan, Avram, that's not your cup of tea
Yeah, I mean,
here.
I know what it is, but I was like, I don't know how that applies to
Yeah.
non-recourse loans, though.
Well, it's yeah,
So-
they're unrelated. So if you do have a
Got it.
participant loan, that's fine. I'm sure you can still get a non-recourse loan if you
Absolutely.
have more cash to satisfy the requirements. Obviously, once you take the loan out, as far as the participant loan, you pull in the cash out of the 401k. So if there is no cash, you won't be able to buy a property if you don't have enough money for a down payment and reserves. But if you do, and you still have outstanding participant loan, you certainly can get a loan, non-recourse loan.
Now, I kind of wanted to piggyback off you a little bit, Dmitry, if I could here real quick. On a participant loan, as we know, it's up to 50%, maximum 50,000. So I just want to bring an example. Let's just say you have $100,000 loan, $100,000 in your retirement account, and you took 50,000. You cannot take that 50,000 and invest into a non-recourse loan. I don't know if that's maybe the question the customer was asking, but we won't be able to do that. If we see that there's a participant loan out there, if we only will look at additional funds, we won't be looking at that money that's supposed to be staying in the retirement. Just for clarity.
Question about the slides, Avram. The presentation slides will be available. I do have a copy of the question for you. Are you okay to share the slides?
Let me just make sure I don't.
Okay.
Let me think about that one.
Yeah, why don't you give me that answer? And if you give me that answer, I can make it available to you guys. Next question from Gabriela. As an LLC owned by the solo 401k, can we buy land? Well, you sure can buy land. As far as getting a loan, Avram?
No, we won't be able to do land. Raw land, no. Yeah, and no construction lending. We don't do that stuff. Mostly existing buildings is what we do. Existing build.
So again, you can buy land. She's not asking, can you get a loan? You can buy land, but you just won't be able to finance that.
Yeah.
Sagita asking, do rents you collect have to go into the Solera checking account?
If the account is, if it's checkbook control, yes, it does. And so do the payments have to come out of the account, as well as the reserve have to be with Solera. Now, if it's a custodian IRA, then obviously we have to go to your custodian.
Okay, I don't think we have anyone on this call who is the case. I think I'll have checkbook control. Another question, can we write checks for living expenses from Solera checking account? Well, that's not related to lending, but you absolutely cannot use your 401k for living expenses. Your solo 401k is for investments only. Using your checking account for living expenses will be violation of the rules. That's a prohibited transaction. To pay living expenses, you have to take a distribution. You have to pull the money out of a retirement account, and then that's your money. You do whatever you please with it. But you can't use your 401k or IRA for living expenses. That's a prohibited transaction. And then question, how much reserves are required?
Usually 6 months worth of your monthly mortgage. So principal, interest, taxes, and insurance plus HOA.
Okay. Thanks. Couple more. Lots of good questions today. Does Solera finance in all 50 states?
Yes, we do finance in all 50 states, but 2 states are a little bit tougher to do, and they're usually case by case, is New York, New Jersey. But we do all 50 states. We just there's a little bit additional criteria for New York, New Jersey.
Do you do fix and flips and fix and holds?
Do not, unfortunately.
Do you check my personal credit score?
Yes, we do.
And do you require personal tax return, W-2s, 1099s, and personal income?
Do not look at your personal income, as it's irrelevant.
Okay. All right, that will be it. Thank you guys for joining us. Well, almost
Dimitri?
everyone still till the end. Yes.
Just quick thing. We are going to be, this is recorded and it will be posted on your website, correct?
Yes, we'll make the recording available.
I would say because these slides were not approved by our compliance, we won't be able to share that, unfortunately. So they can see the webinar, but unfortunately we can't send the presentations there because it's not approved by our compliance. It was just created by me, so we probably shouldn't be sending that out.
because you use your internal like a spreadsheets. Okay, makes
Yeah,
sense.
yeah,
Well,
but you could
yeah,
definitely the
again,
website.
guys, yeah, just you can watch the recording to view it. Avram, thank you so much for just great information. Lots of
Absolutely.
great questions. Thank you guys for joining us. And we will make the recording available so you can watch that or rewatch that. And um, we'll see you next time.
Thanks for having me, Dimitri. Thank you, everybody, for your time. And you guys all have a blessed day and evening.
Bye.
Bye-bye.